Here's something mind-blowing. Imagine having enough money to buy 2.5 million houses, then losing it all in one decision. That's essentially what happened when this Japanese bank sold off $100 billion in U.S. bonds.
That comparison really puts the scale of this decision into perspective. We're talking about an amount of money that could transform entire economies.
You know what fascinates me most about this story? It's how success actually planted the seeds of their downfall. This bank had built such an impressive track record that they started believing they were infallible.
The psychology behind that transformation is remarkable. How does an institution go from being ultra conservative to essentially gambling away its future?
Well, it's like watching someone who's won at the casino 10 times in a row convince themselves they can't lose. The bank had navigated so many challenges successfully that they developed what I'd call institutional immunity to doubt.
Hmm, that's such an interesting way to put it. And the timing of their decision couldn't have been worse, right? They essentially sold at the bottom of the market.
Exactly. And here's what makes this story even more compelling. While this bank was making this catastrophic decision, another Japanese bank looked at the exact same market conditions and made the opposite choice. They held their positions and ended up thriving.
That contrast really drives home the lesson. What do you think was going through the minds of the executives when they made this call?
You know, based on the market analysis from that period, they were likely convinced that U.S. bonds were going to keep declining. But here's the kicker. They ignored one of the fundamental rules of investing. Never try to time the market, especially not with $100 billion.
The ripple effects must have been enormous. When an institution of this size makes such a dramatic move, it doesn't just affect them.
Oh, absolutely. And here's a statistic that really drives this home. The decision affected roughly 40% of their total asset base. It's like they took nearly half their chips off the table in one move.
That's incredible when you think about it. The sheer scale of this decision must have sent shockwaves through the entire global financial system.
And what's particularly fascinating is how this event changed Japanese banking culture forever. After this, we saw a fundamental shift in how Japanese institutions approach risk management. It's estimated that risk assessment procedures in major Japanese banks increased by 300% in the following decade.
So, in a way, this massive failure actually led to some positive changes in the industry?
Exactly right. It's like how the 2008 financial crisis led to stricter banking regulations. Sometimes it takes a catastrophic failure to create meaningful change. And get this, the successful bank that held on to their bonds, they ended up seeing a return of nearly 40% on their investment over the next 5 years.
Well, that really shows the value of staying the course during turbulent times.
And here's what I find most relevant for today's financial world. The lessons about institutional arrogance are just as applicable now. Recent studies show that roughly 80% of major financial institutions' failures can be traced back to overconfidence in decision making.
That's such a crucial point for modern financial leaders to keep in mind.
Looking toward the future, I think this story will continue to serve as a powerful reminder that in finance, sometimes the best move is no move at all. It's estimated that reactive trading decisions cost institutional investors an average of 20% in potential returns annually.
Sounds like patience really is a virtue in the financial world.
You know what they say. The market is a device for transferring money from the impatient to the patient. And this $100 billion mistake might just be the most expensive lesson in patience ever recorded in financial history.